WeWork didn't sell desks. It sold a feeling. It took the most boring product in modern life, office space, and wrapped it in the language of belonging. Not square footage, but community. Not leases, but membership. Not a landlord, but a movement. The pitch wasn't that you would rent a place to work. The pitch was that you would join something larger than yourself, walk into a building, and instantly become part of a tribe that was building the future. And for a while it worked, because the age it was born into was hungry for exactly that. Work was getting lonelier, cities were getting more expensive, startups were multiplying, people were moving faster than their friendships could keep up. So when someone offered an office that looked like a startup incubator and felt like a social club, the product seemed obvious. The couches were warmer than corporate lobbies, the coffee tasted better than the break room. The walls had murals instead of policies. The lighting made everyone look like they were filming a documentary about their own success. But every bubble has two stories. The public story is always poetic. The private story is always contractual. WeWork's public story was community. Its private story was obligatory. Because underneath the plants and neon signs, the business model wasn't new. It was an old trade, dressed in modern language. Long-term commitments on one side, short-term customers on the other. The kind of mismatch that can look like genius during a boom and feel like a trap the moment the cycle turns. Think about what WeWork was really doing. It would walk into a city and sign leases that ran for years, sometimes decades. It would commit to fixed rent payments and escalating costs, then spend heavily to convert generic office floors into a branded experience. Glass meeting rooms, polished concrete custom furniture, phone booths, communal areas designed to blur the line between work and lifestyle. That renovation wasn't cheap. It wasn't optional. It was the product. The build-outs were how you turned an ordinary building into a WeWork building. Then, instead of renting out those floors like a traditional landlord, it sold flexible access, month-to-month memberships, small team agreements, hot desks, packages that could be upgraded or canceled with far less friction than a standard commercial lease. In other words, it borrowed time from the future and sold convenience in the present. That spread trade can be a goldmine when demand is rising. If offices are filling and companies are hiring, flexibility becomes a premium product. People pay extra to avoid long commitments. Startups love it because they don't know what they'll look like next year. Corporations love it because it lets them experiment without committing to a full lease. In a growth era, flexibility feels like the smartest version of real estate, but the spread trade also has a natural predator: volatility. When uncertainty hits, customers cancel fast. They shrink, pause, disappear. But the lease doesn't care. The lease is a contract, not a vibe. It doesn't cancel because your members are anxious. It doesn't renegotiate because your community is struggling. It demands the same payment every month, on time, regardless of how full your floors are. This is where WeWork's story becomes less about a charismatic founder or a flashy brand and more about the raw mechanics of risk. WeWork wasn't just exposed to the real estate market, it was exposed to something sharper: the gap between long-term promises and short-term confidence. And the only thing that makes that gap survivable is money, cheap money, plenty of it. Money that keeps coming year after year, funding expansion, subsidizing build-outs, covering losses, buying time. Because once you choose this model at scale, you don't really have the option to slow down gently. Slowing down means the fixed costs catch up. Expansion is how you keep the machine looking alive. That's why the company's growth wasn't just ambition, it became necessity. The brand promised endless momentum. The valuation assumed it. The internal culture lived on it. If you've ever watched a high-wire act, you know the trick isn't just balance, it's forward movement. You don't stop in the middle of the rope and think carefully. You keep going, because stopping is what makes you fall. And in the age WeWork rose, forward movement was rewarded more than stability. Investors weren't paying for profit. They were paying for narrative. They weren't buying earnings. They were buying inevitability. This is the era when companies learned a dangerous lesson. You can lose money and still be celebrated as long as you call the losses investment, and as long as you can persuade the market that scale will one day turn the red ink into a moat. But WeWork's red ink wasn't a temporary marketing spend or a platform build. A large portion of it was structural. It was baked into the physics of the model: long commitments, heavy build-outs, and a product that required constant curation to justify its premium. That's what makes the community story so important. Community wasn't just branding. It was the justification for pricing. It was the reason members would pay more than a bare office. It was the explanation for why this wasn't a landlord business. If you can persuade people the product is culture, you can persuade capital markets the company is tech. And if you can persuade markets your tech, you can persuade them you deserve a valuation that doesn't behave like real estate. Real estate is supposed to be boring. It moves slowly. It's limited by physical constraints and local demand. It's valued on cash flow and occupancy and rent per square foot. Tech is supposed to be explosive. It scales fast. It's valued on growth and networks and future dominance. WeWork tried to live in the second world while operating in the first. That tension isn't moral. It's mechanical. It's a question of what happens when the story and the structure disagree. At the peak, the story was powerful enough to drown out the structure. When money is cheap, confidence is high, and markets are hungry for the next big thing, a beautiful narrative can operate like gravity in reverse. It can pull valuation upward even while the fundamentals pull downward. It can suspend disbelief. It can create the sensation that ordinary rules don't apply. But fundamentals are patient. Contracts are patient. Covenants are patient. A covenant is a quiet sentence hidden inside financing documents that tells you how the game ends. It's the part of the system that says you can tell whatever story you want, but if you cross this line, consequences trigger automatically. Most people never read covenants. They don't have to. In good times, covenants are invisible. They're like the bolts in a bridge. You only think about them when the bridge begins to shake. When WeWork's growth story began to fracture, the covenants became the real plot. Because once the market stops believing, the cost of capital rises, refinancing becomes harder, creditors become less patient, and the company's options shrink fast, not because the brand is weaker, but because the legal architecture tightens. Here's the brutal truth about modern business. Confidence is a resource, and debt contracts are built to protect whoever lends it. If the story cracks, lenders and landlords don't ask how inspiring your mission is. They ask if you can pay, they ask if you can meet coverage ratios, they ask if you can comply with the rules you agreed to when the world was optimistic. And WeWork's model was especially sensitive to confidence because it relied on a kind of continuous replenishment. It needed to keep filling space. It needed to keep renewing members. It needed to keep expanding enough that the losses could be framed as growth rather than decay. Even small changes in occupancy and pricing can become existential when fixed obligations are massive. Real estate doesn't collapse slowly at the corporate level. It can feel stable right up until it doesn't, and then everything becomes negotiations. And negotiations are where the romance ends. Because WeWork's real counterparties weren't just members. They were building owners, lenders, bondholders, and the market itself. When a member cancels, you lose revenue. When a landlord loses confidence, you lose leverage. When a lender loses confidence, you lose oxygen. That's why the phrase cash burn is too gentle for what was happening. Burn implies you're spending money on purpose, like fuel. But fuel only makes sense if it's moving you towards somewhere survivable. When the burn becomes structural, the fuel starts looking more like a countdown. The burn rate wasn't just the cost of growth. It was the cost of carrying commitments that did not shrink just because the world got more uncertain. And the world did get more uncertain. Cycles always turn, but what made WeWork ES era so punishing is that it didn't want to just face one problem. It faced a shift in the environment that made its assumptions fragile. Flexibility is valuable until everyone wants flexibility at the same time. When demand for office space becomes unstable, members prefer to be short-term. That means more cancellations, more renegotiations, less pricing power. Meanwhile, the company is still carrying long-term rent. This is what makes the spread of trade dangerous. It's like an insurance company that sold policies assuming disasters were rare, then discovered disasters can cluster. You can handle churn when the churn is random. You can't handle churn when the churn becomes synchronized. And once synchronized churn hits, the legal machinery wakes up. That's when covenants start dictating the calendar, interest payment dates, grace periods, default triggers, cross-default clauses, the small print that turns into the loudest voice in the room. At that point, the company becomes less a community brand and more a distressed financial structure. People often say WeWork failed because it was a cult of personality or because the valuation was absurd. Those things mattered, but they were symptoms. The deeper cause was that the company built a cathedral of narrative on top of a foundation made of contracts that required constant stability. It wasn't just selling to the community, it was borrowing confidence. And borrowed confidence comes with terms. There's a strange psychological shift that happens when a company enters covenant territory. The product may still function, the buildings may still be open, people may still work at those desks and drink that coffee and hold meetings in those glass rooms, but the atmosphere changes because the market starts reading you differently. A company in covenant trouble stops being evaluated as a growth story and starts being evaluated as a liquidation problem. The questions shift. Not how big can it become, but who gets paid first. Not what's the mission, but what's the recovery value. Not how strong is the community, but how long until the leases are renegotiated. And this is where the hidden nature of WeWork's business finally becomes visible to everyone. Because commercial real estate, at scale, is not a lifestyle brand. It is a system of payments. It is a chain of promises, stacked on top of each other. Landlords owe lenders, companies owe landlords, investors owe their own investors. Everyone is passing money along. When that chain is moving smoothly, it looks like prosperity. And when it breaks, you realize what it always was, a network of obligations held together by confidence. WeWork's collapse, then, is not just a corporate soap opera. It's a case study in what happens when an era confuses narrative with durability. In the decade of cheap money, story was often enough. Capital was abundant and patient. Rates were low. The market was willing to fund losses if the losses came with a believable path to dominance. But real estate does not behave like software. You can't scale physical space without scaling physical costs. You can't iterate away the fact that walls and leases are real. You can't A/B test your way out of rent. So the question becomes, what was WeWork actually building? If you listen to the story, it was building a global platform of human connection. If you read the contracts, it was building an enormous portfolio of long-term liabilities and trying to monetize them through short-term relationships. And relationships, unlike contracts, can evaporate. That difference is everything. Once WeWork entered restructuring, the logic became brutally simple. The goal was no longer to grow. The goal was to survive. And survival in this context meant doing what normal market forces would never allow politely, rewriting obligations. That's what bankruptcy protection is, in practice. It's a legal machine for converting impossible promises into smaller promises. It's a reset button that doesn't erase the pain but changes who carries it. Lease obligations get cut, debt gets restructured, ownership shifts to creditors. The company emerges smaller because the grand dream was too heavy to carry through the door of reality. And this is the part that reveals the hidden anatomy of modern capitalism. In a system built on contracts, failure isn't just collapse, it's a redistribution. When a company like WeWork restructures, the story that used to belong to founders and investors gets handed to lenders and landlords. Power shifts from vision to enforcement, from charisma to claims. The community doesn't disappear overnight. People still want places to work. Co-working itself doesn't die because one brand stumbled. The need was real. The market was real. The desire for flexibility and social connection was real. What died was the fantasy that you could treat that need like a tech platform and finance it like a perpetual motion machine. WeWork, in the end, became a reminder that the most dangerous thing a company can do is confuse a beautiful idea with an invincible structure. Because community is not collateral. Cash burn can be justified for a while. It can even be celebrated. But eventually, the burn meets a boundary. And that boundary is written in the language the market trusts most: contracts, covenants, or gravity. They are the force that brings stories back down to earth. You can float on narrative when the wind is behind you. You can climb on valuation when the market is euphoric. You can grow on subsidies when capital is cheap, but you cannot outrun obligations forever. WeWork's story is often framed as a cautionary tale about hubris, about excess, about a founder who believed too much. But the more important caution is systemic. What happens when an entire era rewards growth over resilience? This wasn't just one company's mistake. It was a pattern of the age. The age told companies, expand first, justify later. The age told investors, chase the next platform, even if the platform is made of drywall. The age told the market, believe the story because belief itself creates value. And for a while it was true. Belief did create value. It created access to capital. It created momentum. It created an ecosystem of hype that felt self-sustaining. But belief is not payment. Belief does not satisfy rent. Belief does not override a covenant. The final irony is that WeWork's brand was built on togetherness, but its downfall was engineered by the most impersonal forces imaginable: interest payments, occupancy rates, lease terms, and legal triggers. That's how modern bubbles usually end, not with a dramatic final scene, but with a quiet deadline, a missed payment, a grace period, a default notice, a restructuring term sheet, a court filing, a plan approved, a company reborn smaller than its myth. And once you see it, you start noticing the pattern everywhere. Any business that takes long-term obligations and funds them with short-term confidence is playing a version of this game. It can work for years. It can look like genius. It can produce stunning valuations. But it always carries the same risk. The moment the world demands certainty, the model demands faith, and faith is expensive when fear is rising. So what survives from the WeWork era? The simple insight that humans do want community, even at work. That flexible space is valuable, that cities will always contain people building dreams who can't afford traditional commitments. Those truths remain. But alongside them survives a darker lesson, one the market keeps learning and forgetting. Stories can scale faster than structures. You can build a brand that feels limitless, but the contracts underneath it are finite. They have deadlines, they have penalties, they have clauses designed for the moment when optimism dies. WeWork was a story that tried to outrun its own paperwork, and the paperwork won. Because in the end, capitalism is not governed by slogans, it's governed by claims, by who owes what, to whom, and under what conditions. Community can make the room feel alive. Cash burn can keep the lights on. But covenants decide who owns the building when the music stops. History has the answers. The contracts show you where to look.